In today's video, I will explain how a covered call financial advisor can generate stock income that also serves as a buffer of downside protection in the event that the stock falls. The example that I will walk you through today generates stock income called hedged income of 50.4% over an investment horizon of 22 months, which is just under 2 years. If by the end of this investment horizon, the stock has risen to any degree, then the strategy delivers a return of 50.4%. I've been investing with covered calls since 1999. My name is Ron Didesco. I'm a CFA charter holder, which stands for Chartered Financial Analyst, and I am a covered call financial advisor with Bespoke TFC Capital. Let's take a look at this portfolio example. Today's stock investment strategy is for shares of Bloom Energy, which provides clean energy solutions. Over the past year, shares of the stock have rocketed from $16 a share to as high as $302 before pulling back to the current level of $250 a share. Because the stock has moved so significantly within such a short time period, the market expects that the stock will continue to be volatile going forwards. This makes the stock a prime candidate for entering into today's investment strategy called a covered call. We'll take a look in a minute, but just be aware that the only reason that the numbers will be so significant in a moment is because the stock has been so volatile within such a short time period. What do Wall Street firms think shares of Bloom Energy are worth? Let's take a look. Target prices from Wall Street firms are $254, $235, $285, $279, $235, $295, $267, $217, $310, and $255. So Wall Street firms think the stock is worth somewhere between $217 and $310 a share, while the stock currently trades at $250. That's quite the dispersion, and something you should keep in mind is that there is the possibility for the stock to move significantly lower in the future or materially higher, significantly outside of this band of where Wall Street firms currently think the stock should be trading. What can an investor do if someone would like to add this stock to his or her portfolio? Well, let's take a look at a strategy that optimizes the balance between total return potential and downside protection with this covered call strategy. This stock investment strategy is called a covered call ATM. ATM stands for at the money. This means that the strategy consists of buying shares and then selling someone the option to buy shares from you at a later date in the future with no share price appreciation potential. Why would you do that? Because you receive income called hedged income or covered call income. Instead, this is your guaranteed income to keep so long as you maintain this investment until the option expiration in the future, which in this case is 22 months. Here's how the strategy functions. The first step is to buy 100 shares of the stock at the market price. The reason 100 shares is because this strategy needs to be implemented in increments of 100 shares because the second step is to sell a call option, and one call option is equal to 100 shares. So the first step is to buy 100 shares at the market price, which in this case is $250 at the time of implementation. The second step is to then go into the options market, which expires in this case in 22 months, and to sell one call option at a strike price. The strike price is the price in which the buyer of the option has the right to buy the shares from you, meaning the price you will be contractually obligated to sell the shares at in the future if shares of the stock are at or above this price. In this case, that call option strike price is $250. So this contract that you're entering into requires you buying 100 shares at $250 and then selling away any upside potential, meaning that if shares are above $250 at the conclusion of this investment horizon in 22 months, then your shares will be called away from you. You will be forced to sell your shares at $250. Well, why would you buy stock at $250 and then agree to sell the stock at just $250, no share price appreciation potential in 22 months? The reason is that you generate covered call income or hedged income equal to $126 a share. Again, this is your guaranteed income to keep regardless of where the stock closes in the future, so long as you maintain this position until that option expiration date. In the event that the stock is above $250 by the expiration date in 22 months, then the stock will be called away from you, hence the name covered call. You will be forced to sell and you profit $126 a share. If the stock is unchanged at option expiration in the future, then you will continue to own the shares. The option that you sold expires worthless and you keep $126 a share, meaning that if the total share return over 22 months is zero, you keep $126 a share. In the event that the stock falls to any degree, then you will continue to own the shares. the option that you sold expires worthless, and you keep that income of $126 a share. Let's take a look at how the strategy is implemented. Shares of Bloom Energy, ticker BE, currently trade at $249.90, so call that $250. The first step is to buy 100 shares at the market price of $250. The second step is to go into the options market, expiring at a later date, which in this case is March 17th, 2028, which is 22 months in the future. This strategy consists of selling a call option at a strike price of $250 a share. The bid, or the price that someone is willing to pay right now, officially is $124, and the ask, the price in which someone is willing to sell this contract, is $128. This right now will probably net out to about $126, approximately the midpoint. So the strategy consists of selling that option, which is a call, so a call option with a strike price of $250, and receiving approximately $126 a share. Let's take a look at the covered call math. The first step consists of buying 100 shares at the market price of $250. The second step is then to sell one call option expiring in 22 months, just under 2 years, at a strike price, which is the capped upside potential. In this case, that number, the strike price, is $250 a share. In exchange for limiting your maximum share price appreciation potential to 0, you receive hedged income from selling the call option, which is equal to $126 a share. This means that in the event that shares fall by option or hedge expiration in 22 months, that the downside break-even price for the strategy is $124 a share. Given that the stock currently trades at $250, the stock would have to fall more than 50.4% over the next 22 months in order for the strategy to lose money. The hedged income received for the strategy is equal to 50.4%. Because there is no upside potential in this strategy, the maximum potential return for the strategy is 50.4%, which is equal to that hedged income. Let's take a look at this covered call strategy. The hedged income received is equal to 50.4%. There's no dividend paid for the stock, and the capped upside potential is 0%. There's no share price appreciation potential. So over the investment horizon of 22 months, the total return potential is the sum of the hedged income, 50.4%, plus dividend income, which is 0, plus the capped upside potential, which is 0, for that total return potential of 50.4%. In the event that the stock falls by strategy expiration in 22 months, then that hedged income of 50.4% serves as that buffer of downside protection, meaning that the stock has to fall more than 50.4% over the next 22 months in order for the strategy to lose money. Let's take a look at scenario analysis that reflects where the stock may be trading at covered call expiration in 22 months and what associated returns would be. So here we see the share price at covered call expiration in 22 months, along with what the stock only return would be, and then what the hedged return would be. So if shares of the stock at covered call expiration in 22 months are trading at $250, meaning the stock return would be 0, well, in that case, the hedged return, or the covered call investment return, would actually be 50.4%. What you'll see here is that if the stock rises to any degree by hedge expiration or covered call expiration in 22 months, then the strategy has its profit capped at 50.4%, irrespective of how high the stock trades. The strategy is capped at 50.4%. This is the inherent limitation of the strategy. Now, the benefit is that if the stock rises, but to a degree that is less than 50.4%, this strategy significantly outperforms the stock ownership only strategy, particularly on a risk-adjusted basis. Let's take a look at some scenarios. So if the stock were to rise, say, 16% to $290 at hedge expiration in 22 months, the hedged return of the covered call strategy delivers 50.4%. If the stock rises 48% to $370, then the hedged return, the covered call strategy, still outperforms at 50.4%. If the stock were to continue to rise, say it closes at $410, which is a stock return of 64%, well, then that exceeds the hedged return of 50.4%. As the stock continues to move higher, then the stock return would outpace the hedged return. In the event that the stock falls to any degree, this is where the strategy really shines. So let's just say that the stock falls from $250 to $215, which would be a decline of 14%. Well, the hedge strategy actually delivers a profit of 36.4%. That's because there would be a loss on the shares of 14%. However, of the 50.4% hedged income, that is yours to keep. And the difference between the hedged income of 50.4% and the share price decline of 14% nets out to a profit of 36.4%. If the stock were to continue to fall further, say the stock falls as much as 42%. If the stock falls 42% to $145, this strategy actually profits 8.4%. If the stock continues to fall, then there is a point in which losses are realized. So if the stock falls 56% to $110, this strategy loses 5.6%. As you can see with this strategy, the benefit is that there is significant income potential and a really compelling return that can be achieved if your capital has very little movement to the upside, is unchanged, or even falls to a significant degree. The limitation is that if the stock rises substantially, the maximum return you can receive is capped at that 50.4%. Let's talk about some portfolio investment notes. So first off, this does not constitute investment advice. Individuals are different, and at Bespoke TFC Capital, we create customized covered call portfolios that are unique to each individual. We charge a flat fee of just 1% of assets under management with no incentive fees for customized hedging. Additionally, here we are. All client portfolios are customized with diversification and portfolio weights and strategies that are tailored to each client. Each individual is unique, each portfolio is distinct, and what you're seeing here with this one portfolio investment consideration does not constitute investment advice. If you liked this video, I would appreciate if you could like, subscribe, and leave a comment. If you'd like to see portfolio examples for various strategies in different dollar amounts, go to our website at bespoketfc.com, and in the top right-hand corner, click Insights, or go to bespoketfc.com/insights. Thank you for watching, like and subscribe, and hopefully I'll see you in future videos.